A warm welcome to the Risk Reversal Podcast. I'm Guy Adami. Of course, that is Elizabeth Thomas, she of SoFi. She's also a bit despondent. Maybe that's too dramatic a term, but her Packers of Green Bay went down to the hapless Browns of Cleveland, who may have the best defense since the '86 Bears.
Don't try to make me feel better that it was a good team that we lost to. It was bad. It was a low-scoring game. It was a boring game.
Yes.
Because it was 0-0 for a long time, and then it was 3-0 for a long time. And then just the wheels came off the bus. I don't know. It was, I'm glad we got it out of the way. Mm-hmm. We got the embarrassing loss out of the way, and we learned from that and move forward for the rest of the season. I saw something on Twitter today, and this was very like financial media sort of, but it was just about football. And it said something like, early in the season, the Packers lost to a team on the road, last minute field goal, the quarterback had thrown an interception, whatever, all the similarities to the game that happened yesterday. And then it was like, and guess when that happened? 2010,
Super Bowl
fall
season.
of 2010. And guess when they won the Super Bowl?
Yes.
Early 2011. So, if history should repeat itself, we look like we're in good shape. We're following, when they make those charts of like, here's what happened on the chart in the late 90s. Here's what's happening today, following the same pattern. If we're following the same pattern, I'm okay with it.
All right, so let's stay with that theme. By the way, that was the Brett Favre, I believe, Green Bay Packers.
But that was Rodgers, actually.
Oh, that was the Aaron Rodgers squad?
Yeah.
Oh, wow.
Favre was when I was younger.
Favre.
90s.
I like when I say
90s,
that.
Yeah.
Yes. Look at how fast time goes by. It is quite remarkable. Okay, so here we go. So history is clearly not repeating now because we're looking at a market that continues to sort of do the grind, which is fine. It's want to do. We're getting more encouraging news flow out of semiconductors. Apple has finally sort of gotten off the mat and is approaching its prior all-time high. So you have a market churning on all cylinders in a week where there's really not a lot of economic data. You have some Fed speak. I don't think you hear anything different from Warren Greenspan. Warren Greenspan. You had me Warren Buffett and Alan Greenspan, Jerome Powell. But there you are. I mean, that's what the week is. PCE on Friday may be a little bit of a wild card. What are your thoughts?
Well, so sometimes these weeks actually end up being the most interesting in the markets because the market is completely left to its own devices. We don't have earnings season going on. We don't have any big economic releases to react to. So things just sort of start moving. And these are usually the weeks where something will happen and everybody's like, why? What was the event? What was the news story? What sent that in whatever direction? And they can be the most interesting because everybody's trying to figure out what happened. So thoughts right now, gold just hit a new all-time high. Okay. So I think we have to have thoughts about that. But thoughts right now are some of the commentary that's coming out. If you're following, research over the weekend, if everybody spends their weekends doing what you and I do, which is just sitting around poring over research reports, right? My baby loves doing that with me. But the commentary that's coming out are things like, I think it was Tony Pascarella from Goldman, who said something along the lines of, ride this, but don't chase it. So it's sort of like, is this a sit on our hands moment as investors where you assume that everybody is at least exposed to what's happening, exposed to this rally, but it's not the right time to suddenly throw a bunch of new money at it. But it's also not the right time to pull all your money out because it could keep going for some time. So you just sit on the positions you have. And I think that's a really difficult place for investors to be, especially in today's market, because you wake up every day thinking that you're supposed to do something. You're supposed to trade something. You're supposed to find a new opportunity. And that's when the churn starts to happen. So, if people have all this cash on the sidelines, we probably see some interesting moves happen in markets this week.
Well, Tony P is actually a friend. I've gotten to know him over the years. He does very thoughtful work, as do you. And this is somebody, by the way, I don't want to say he's been a resounding bull, but he's been very optimistic. So when you hear him say something like that, I mean, I'm not saying he's changing course by any stretch, but it sounds hauntingly familiar to what we heard from David Tepper last week in terms of his thoughts on the market. Again, he wasn't effusive in his praise of the market. I think he was torn as well. Valuations don't make a lot of sense, but he sees no reason to sort of throw in the towel. And, that's a sort of an interesting inflection point in the market that I think a lot of people are struggling with. And for the life of me, it's hard for me to come up with the catalyst that's going to derail this thing. I mean, obviously valuation's been a concern on a number of different metrics. We say all the time that that's not a timing tool, but with each passing day, we seemingly get more and more expensive. I would submit that each piece of good news out there has been magnified sort of 3 to 5x, and the bad news has sort of been completely discounted. And I don't know when that pendulum swings, well, I shouldn't say ever, but if it swings in the near term future.
Well, usually when we have environments like this where we can say, I don't see the catalyst that's going to be the problem, it's not the problems that we're anticipating. It's something out of left field, which none of us can ever figure out, where it came from. We couldn't have gotten in front of it. So there's no sense in trying to get in front of this imaginary event that could occur. It could happen this year. It could happen next year. It couldn't happen for another 5 years, right? You can't invest that way. So then you have to think about, so what do you do today? And I'm going to defend the me's of the world a little bit, and I'm putting strategists in this camp. I'll put analysts in this camp. Anybody out there who's trying to write research or give some sort of guidance on what to do with new money and where to invest, we all have either a fiduciary duty or just the plain old prudent man rule, where yes, it seems like this market could go further up, but is that the prudent thing to do, to chase it up further and further and further at these levels of valuation, when every metric, every mathematical metric is telling you it's expensive, it's stretched, it's probably time for some kind of shakeout, pullback, whatever. How long can this go on, right? We're starting to hit levels. I just saw on CNBC, we are hitting tech spending as a percentage of GDP almost at the 1990s peak. So there's a lot going on right now that sort of ring off these yellow alarm bells, maybe not red yet, but yellow alarm bells. And everybody who's trying to give that guidance, starting to hear the hedging that they're doing in the guidance, because it just doesn't make a ton of prudent sense to put more money behind it. So you have to think about, where can you feel comfortable with that? I think you can feel comfortable with that in some thematic ways, not single securities. I wouldn't be chasing single securities at highs. I wouldn't be chasing some of the really idiosyncratic stuff at highs. I wouldn't be chasing meme stocks, things like that. But in thematic ways, you can probably execute some things. We've talked on here about software versus semis. I still think that there are opportunities in some of the software areas. Cybersecurity is a longer term play that I'm always looking at, opportunities to buy there. I still think you can look at healthcare. I still think there's growth in healthcare. So there are places to put money to work, but they're getting fewer and fewer as the days go by.
Yeah, and I'm not going to ask you to play stock market, but I will. Salesforce finds itself in sort of that software camp, and Dan and I have talked about it on Market Call, a couple times now. In April of this year, the stock traded down to about 230 or so and bounced, and we did it again in August of this year, and here we are approaching 250, and I think we're about to break a downtrend that's been in place for the better part of 12 or 13 months. So I think you're right in terms of the pendulum maybe swinging to software. But you mentioned gold earlier, and I want to sort of pick up on that, because you and I have said a number of times, gold is seemingly working in every environment. And you have a day today where I don't see any particular reason for the move, but you have a gold market basically making new highs, up almost 2%. And I'm not necessarily sure what it's on the back of, other than just a continuation of what we've been seeing now for the better part of a year and a half. Thoughts on that?
Well, there's some news about Argentina today, but I can't imagine that that's big enough to move the entire gold market.
Agreed.
But it could just be fueling the consternation and sort of insecurity that we're having about currency volatility, which I think has driven assets to gold. It's driven money to gold, whether it's central bankers or even retail money. But some of that big institutional money that has gone to gold in order to protect from currency volatility that's been happening around the globe. So that could be part of it. But I still think we're in this trend where you've got an asset that's been producing really attractive returns, outsized returns from what you would expect from something like that. I mean, I remember 2 or 3 years ago talking about gold on one of these shows with you guys and being like, I know it's boring. I know it's like old, stodgy, investment that most of the young kids these days, the new retail traders, would wonder why we'd ever even bother looking at this. And look at it's outperformed stocks for quite a while. So, and it continues its trend upward. We thought in spring that gold had hit its top. This is after the volatility in April, and We thought, okay, we've squeezed all the juice out of it that we can get. And then it moved sideways for a while. But I think the important thing about it is it didn't break. It didn't break down. It just moved sideways. And now it's starting to find another leg up. So I still think there's more opportunity in gold. Yes, it's at a really high level. Yes, you've probably missed a decent amount of the run if you haven't been in it up until this point. But if you are in the Tony P camp and you're just holding on to your exposure in this market, your exposure is heavily weighted towards growth and momentum stocks, then you need something to offset that. And I think gold is one of the good diversification options in that realm.
I agree with you, and we've been in accord for quite some time, and I don't see anything which is a problem. I mean, I like to try to find times when you see what can derail a story, and I'm hard pressed to figure it out, other than potentially a central bank announcing that they're going to start to unload some of their gold reserves or something like that. But short of that, I don't know what the bear case is, unless maybe the Fed becomes more hawkish. But even so, I think you would agree, hawkish Fed, dovish Fed, rates higher, rates lower, dollar up, dollar down, all those things are correlated, but gold has been non-correlated in terms of its movement. And I do think, maybe gold should be looked at as the new VIX. Anyway, we'll talk about that, I'm sure, more over the next couple of weeks. Let's turn to the bond market. And I know you know this, but on the Fed announcement of a 25 basis point cut, and whatever you want to term that cut, the initial reaction in yields would go lower. And then since that maybe hour or so after the announcement, all we've seen is rates sort of trudging higher, not in a meaningful way, but as we're sitting here, we probably got 10-year yields back around 4.13 or something like that. I think headed higher. What's your thought? Because September of last year, we saw rates trade lower into the announcement of a Fed cut, and then subsequently rates go back up. Is this a potential replay of what we saw a year ago?
I do think it's a potential replay. We're in a different environment now. We've got a few other cross currents with tariffs and all of the political stuff that's going on with the Fed and pressure that's happening. But I do think it's another replay in the sense that it's not moving the way that at least the administration would prefer. And we're watching, especially short-term rates, move at the same speed as long-term rates, which was odd to me. I wrote about after the Fed meeting that we would have thought basically you would see short-term rates come down and maybe long-term rates go up because people were still worried about inflation, but they felt like the cuts were secured. So the short end gets kind of anchored in that space, but the short end hasn't stayed anchored. And I was just pulling up, as you were talking, the break-even rate. So I've got a 2-year break-even rate, which is just a way to track inflation in the market. So it's what does the market think inflation is going to do? And it's gone kind of sideways. It fell a little bit right after the meeting, and now it's gone a little bit sideways. If the 2-year break-even rate had gone up dramatically, it would maybe make sense that yields had risen because people had continued to worry about inflation over the next 2 years. But right now, that doesn't really appear to be the case in any dramatic fashion. So I think the only thing that you can then conclude is that investors continue to be worried about the fiscal situation, and not just here, but everywhere. We've got global yields on the rise for a lot of this year, and the US is not immune to that. We've got a fiscal situation that is problematic if things don't change. Now, I think things probably will change because they have to, but it doesn't mean that in the meantime, investors aren't going to demand more of a premium to take on this risk.
But right now it hasn't, but I agree with you. And again, I'm one of the few people that think, you probably are somewhat on the fence, and I'm not putting words in your mouth, but I still think you have a meaningful move higher in yields for the wrong reasons. I don't think they're for growth reasons, but as Carter would say right here, we've seen, it's not like we haven't seen 4.15 in, before in terms of rates over the last couple of years. So maybe it's much ado about nothing. I don't know. We'll see how it plays out. I don't want to play stock market again with you, but the home builders, which one would think would be getting sort of a boost on the back of, some of this Fed talk, they have not traded well. And this is going to be a similar conversation as to yields, but all those individual stocks ran up into September, October of last year, and then subsequently declined. And since April, May of this year, they've all started this run up into the much anticipated rate cut. Now they're starting to slide. I don't think this is a function of yields. This is just my opinion. I think this is more a function of the economic outlook, the fact that, there's inventory building on the new home market set, and the fact that the unemployment rate might be worse than the market realizes. Just thoughts on that in general.
So let's start with new home market. And what we talk about a lot is construction employment. So obviously really tied to construction employment and the activity that's happening there. For a while, since COVID, there had been this huge backlog of new homes that needed to be built because the permitting was taking longer. There was just so much demand, and there was demand for materials. They couldn't get the materials. We all know the story with supply chains. So there was this big backlog, and that was supporting construction employment because there was more work than they could find workers for. In more recent months, in just the last few months, construction employment has turned over a bit and has slowed down. Why do we care? We care because, generally speaking, the construction employment curve leads the broader labor market by our calculations about 14 to 16 months. So we've still got a while to watch how this plays out, but you want to watch construction employment for some of those little indicators, and it has broken down over the last few months. So something to pay attention to. As you were talking again, I was just building a chart here. I've got the Homebuilders ETF, and then I overlaid on top of it a company called Home Depot and a company called Lowe's, just to see if maybe there was a difference. And there isn't much. Basically, they've followed the same trajectory. So both of them leading up to this most recent rate cut, rise, rise, rise. And then since then, there's been a bit of a rollover. The reason I looked at that is because you've got home builders, and then you've got some of these more housing related, housing adjacent companies. But if we're not talking about the mortgage market waking up again, then maybe people are going to stay home, remodel, spend more money at stores like Home Depot and Lowe's. That still doesn't seem to be the case. So I think you're probably right. This is more of a cyclicality signal. Home builders are very cyclical. So you see them run up when we're excited about GDP growth and we're feeling like the economy is hot and isn't going to stop anytime soon. They roll over when there's other cyclicality signals happening. I think there's a chance, however, I'm just going to play devil's advocate on this for a second. I think there's a chance that if and when the mortgage rate, the 30-year mortgage rate falls below 6% durably, there might be a little pickup in mortgage activity, a pickup in the housing market, as long as that happens when we're not going into a recession, right? As long as that's not happening because there's been this free fall in rates on the back of some sort of GDP breakdown. If we get below 6%, I think that's a mental threshold enough for people to start reigniting the housing market, even if it's just for a short period of time.
Yeah, I think that caveat is important. If yields fall sort of organically without a catalyst of an economic downturn, I agree with you on that. But not to go off the rails, but knowing you the way I do, which is a lyric of a song, in case you're curious. You have a sister, but my sense is you were sort of more of the tomboy sister, and you probably could sort of wield a hammer. If you were to go into Home Depot, would you know your way around?
I mean, yes. Yeah, I'm comfortable in stores like that, and I can definitely wield a hammer. My husband's very handy, so I don't do much of this anymore because he can do a better job. But, in my single days, yeah, I fixed things more. However, I think my sister and I are equally tomboyish.
Oh, really?
Yeah.
Oh, I like that. I did not know this because I know, you were
Fun fact.
bit of a point guard back in the day, but I
Well, I was also a
digress.
cheerleadon, so, it
Oh,
balanced
yeah,
out with
that's
the
disappointing.
ribbons and pom-poms.
Speaking of cheerleading, no, I'm kidding. You and Mario obviously work together very well. I would imagine it gets either easier or more difficult to try to come up with things, just given this trajectory of the market. But, what is out there that you're thinking about that you haven't started to do work on yet because it's sort of out there in the ether, something that, that in a couple months we're all going to be talking about this, but it's a little bit too early. Is there anything on your radar screen?
Nothing in particular. I'm hesitant to say, at some point, do we need to break the recession handbook out again, right? And then talk about things like that. But I think lately it's been more about what does this yield environment look like in the coming months? And does it ever actually start to affect stocks? I would say if there's something that I would like us to do some research on in a few months, but I think things have to change in the market first, it would be, how did we get here in private markets? right? How did we get to this point in private markets? Where is it because they got democratized and so much money flowed into them? Is it because public markets stopped being attractive to all of that money? And trying to answer the question of, did that actually become a bubble? So we concentrate so much on AI as a bubble, but then there's this little whisper every once in a while in the background about private debt or private, all the other private equity, venture capital. Is that a bubble? And is that going to be the thing that we look back on and say, yeah, we probably should have perked our ears up a little bit more about what was going on there? But the difficult part about that is that it doesn't trade every day. You don't have a way to track it. The data isn't nearly as available to try to track sentiment in that market or figure out what's actually happening on a daily basis.
We will be on the lookout for that. Before we get out of here, Michigan squeaked by, I think that's the right term, the University of Nebraska. By the way, the University of Nebraska team, or what's culture or program that's sort of fallen on hard times over the last decade or so. But with that said, University of Michigan consumer sentiment on Friday, is that a market mover? Because for the life of me, you could tell me it's going to be great, or you could tell me it's going to be lousy, and I would agree with you either way.
Well, I don't think it's going to be a market, unless it's like way out of left field, right? Even then, I don't know that it's really that big of a market mover. I've said this many times, but just to remind everybody again, the University of Michigan sentiment cues more off of inflation. The Conference Board sentiment cues more off of jobs. Lately, because of what the Fed has said, we're all more obsessed with jobs than we are with inflation. So I would find it surprising if this ended up being a market mover. But anything that's way out of bounds, out of expectations, always has that possibility.
What was out of bounds was, again, the Packers lost to the Browns, but maybe that's what we call a trap game. Football appears to be over in the New York metropolitan area as both teams have fallen to 0-3. I think the percentage chances of making the playoffs when you get off to such a horrible start is about 4% or so. And
so you're telling me there's a chance?
I'm telling you there's a chance. It is hard times here I tell you, it's just not, it's NG.
Well, did you see what else happened in Wisconsin this weekend?
Please.
The Brewers clinched the NL Central, won the division for the third year in a row. Obviously, we clinched a playoff berth a few weeks ago, but now also took the division, and celebration is just happening everywhere. So that overshadowed a little bit this embarrassing Packers loss.
No, listen, I think when you have a baseball team on the precipice of another playoff run, you can look past an early season Packer loss, understanding that it's just, one loss in a 17 game set. So your mind can do things, can work for you in terms of that. I mean, obviously you would have liked both teams to emerge victorious. Mm-hmm. But if you were to pick one, I guess, I don't know, maybe it's me. This point in the season, it's got to be the Brew Crew.
Yeah, I'll take it. Absolutely.
Elizabeth Thomas, love joining you. You can find her on SoFi.com/#, all those things. We'll put it in the show notes. We'll talk to you later, folks.